Welcome to Chapter 17, Cross-Border Investing. A foreign security is never just a foreign security. It arrives with a currency, a legal system, a tax regime, a market structure, a custody chain, and a set of political rules that can change while the portfolio manager is sleeping. That is what makes global investing both valuable and demanding. It expands the opportunity set beyond the home market, introduces industries and economic cycles that may be underrepresented domestically, and can improve diversification. At the same time, local gains can be erased by exchange rates, ownership can be limited by foreign investor rules, and an apparently liquid position can become difficult to settle or exit when sanctions, capital controls, or market closures appear. In 1997, investors learned how quickly currency and banking stress could move across Asian markets. In 2008, they learned that international diversification can become much less international when everyone wants dollars and liquidity at the same time. This chapter builds a practical decision system. We will separate local return from currency return, compare developed, emerging, and frontier mandates, evaluate access vehicles such as local shares and ADRs, and connect research to custody, tax, settlement, and exit capacity. A foreign stock comes with a complementary currency position, whether you ordered it or not. The goal is to know what else came in the package. The same company can produce different returns for investors using different home currencies. A stock may rise in Tokyo, London, or Frankfurt, yet a U.S. investor measures the result in dollars. If the foreign currency falls enough, the dollar return can be negative even when the local share price increased. That currency layer is only the beginning. Cross-border investors may also face withholding tax, different accounting conventions, local holidays, shorter trading windows, capital controls, foreign ownership limits, and longer custody chains. The scale on this slide shows why the topic matters. At year-end 2025, in regulated open-end fund assets across 44 reporting jurisdictions totaled about $88 trillion. The United States accounted for about $44.8 trillion, Europe about $27.9 trillion, and the worldwide system included nearly 149,000 regulated funds. Those numbers show a global industry, but they do not make every market equally accessible or every return directly comparable. The correct analytical unit is the home currency, after cost, after tax investor result. A 10% local gain is not a 10% investor gain until we know what the currency did and what frictions were paid. The market likes to put the exciting number in the headline. Cross-border investing often keeps the decisive number in the footnote. This chapter develops 4 practical abilities. First, decompose the return. You should be able to separate local security performance, currency movement, hedge results, fees, withholding taxes, and implementation effects. Second, compare mandates correctly. Global, international, developed market, emerging market, and frontier portfolios are not interchangeable, and the benchmark determines which country, currency, and sector exposures count as active risk. Third, assess the full risk stack. That includes country politics, property rights, accounting quality, governance, sanctions, capital controls, market access, settlement, custody, liquidity, and the ability to repatriate capital. Fourth, implement the exposure using an instrument that fits the mandate and the operating platform. The choices may include local shares, ADRs, cross-listed securities, mutual funds, ETFs, futures, forwards, or swaps. The important word is implement. An attractive valuation is not enough if the fund cannot legally own the asset, receive the dividend, value the position, or exit under stress. By the end of the module, you should be able to explain both sides of the global investing case. Why the broader opportunity set can improve a portfolio, and why the expected benefit may fail to reach the shareholder. Global diversification is not a souvenir collection, it is a controlled system of exposures. 4 connected questions. Organize the chapter. First, what is the investment case? We examine the broader opportunity set, diversification, valuation, growth, factor exposure, and the tendency of investors to favor their home market. Second, what is the currency layer? We separate translation exposure from the underlying security return and evaluate hedging costs, carry, basis, collateral, and policy. Third, what is the country layer? Law, politics, taxes, sanctions, property rights, governance, and capital controls can change the value that an investor can actually realize. Fourth, what is the operating layer? The fund needs market access, approved brokers, local accounts, custody, sub-custody, settlement calendars, foreign exchange execution, tax documentation, corporate action processing, and reliable data. These layers interact. A country decision creates a currency exposure. The currency and market determine which instruments are practical. The instrument determines custody, settlement, and tax requirements. Those operating requirements may determine whether the investment belongs in the portfolio at all. That sequence is important because cross-border investing often fails at the handoff between a good research idea and a difficult ownership structure. A research report is not a passport. The complete position must survive every border between thesis and cash. A cross-border position is a stack, not a single line item. At the center is the issuer. The manager still has to analyze the business model, cash flow, valuation, balance sheet, competition, and management. Around that issuer sits the currency, which adds exchange rate movement, hedging cost, convertibility, and settlement risk. The country layer adds politics, law, tax, sanctions, capital controls, property rights, and macro policy. The market layer adds trading hours, liquidity, price limits, foreign ownership rules, benchmark inclusion, and restrictions on shorting. The custody layer determines where the asset is recorded, which depository or subcustodian is involved, how corporate actions are processed, and whether cash can be moved safely. Finally, the information layer asks whether accounting, audit, disclosure, language, related party transactions, and data timeliness are good enough to support a fiduciary decision. These risks do not have to fail together. A strong company can be trapped inside a weak ownership structure. A liquid security can become difficult to trade after a legal change. A dividend can be declared correctly and arrive late because tax documentation or custody processing breaks. The portfolio manager owns the entire stack, not only the earnings forecast. Sometimes the company is fine and everything around the company decides to have a meeting. A global investment should be evaluated as both a research decision and a market access decision. Step 1 is the mandate. Define eligible countries, currencies, instruments, benchmarks, concentration limits, liquidity requirements, and the hedging policy before the opportunity appears. Step 2 is research. Analyze the issuer or sovereign, valuation, governance, country conditions, currency, tax, and information quality. Step 3 is access. Decide whether the fund should use a local share, an ADR, a cross-listing, a mutual fund, an ETF, a future, a forward, or a swap, and confirm that the instrument is legally eligible. Step 4 is execution. Choose the approved broker, venue, order strategy, and foreign exchange trade, consistent with local market practice. Step 5 is settlement. Coordinate the custodian, subcustodian, depository, cash, tax documents, foreign exchange funding, and local holiday calendar. Step 6 is monitoring. Track the issuer thesis, currency exposure, sanctions, ownership limits, corporate actions, custody, taxes, and the ability to exit. Notice how often the control questions appear before the trade. That is deliberate. The cheapest instrument may be unusable. The most liquid line may be near a foreign ownership ceiling. The best research idea may fail a sanctioned screen. A great investment that cannot be legally owned, reliably settled, or safely exited is not an investable idea. It is an interesting memo with travel problems. The strongest reason to invest across borders is not a prediction that one region will outperform forever. It is the broader opportunity set and the possibility of diversifying economic drivers. Many industries, issuers, and business models are underrepresented in a single home market. Growth, inflation, interest rates, commodity exposure, and policy cycles differ across countries. Valuation can also differ because local sentiment and capital flows price similar fundamentals differently. Currency exposure may diversify a home currency liability, or it may add volatility. Global portfolios can change factor exposure through sector mix, company size, value, quality, duration, and sovereign risk. Investors with foreign spending, operations, or obligations may also need assets in the currencies in which those liabilities will be paid, but diversification is conditional. During the 2008 crisis, markets that looked different in normal times were pulled together by leverage, funding stress, and the demand for liquidity. In March 2020, the common factor was not the local business cycle. It was a global rush for cash and policy support. That does not make international diversification useless. It means the manager must identify which risks are genuinely different and which are linked by the same global funding system. Owning 6 countries is not diversification if all 6 positions are the same dollar, liquidity, and risk appetite trade wearing different flags. Mandate labels determine the opportunity set and the risks the investor agrees to own. A developed or global core mandate usually operates in deeper markets with established institutions, broad foreign access, and relatively liquid currency hedging. That does not eliminate risk. Developed indexes can still be concentrated by country, sector, or a small group of large companies, and geopolitical or currency exposure remains. Emerging and frontier mandates introduce a different operating environment. Liquidity may be lower, foreign quotas, price limits, concentrated ownership, short sale restrictions, or capital controls may apply. Currency markets can be more volatile or difficult to hedge. State influence, related party transactions, legal enforcement, and minority shareholder rights may require more intensive research. Country classification itself can matter because promotion into or removal from a major index can redirect large benchmark-linked flows. Higher economic growth does not automatically produce a higher shareholder return. The entry valuation matters. The quality of governance matters. The share available to minority investors matters. So does the ability to convert and repatriate the proceeds. Students often hear emerging growth and assume emerging return. Markets are not that considerate. A growing economy can have expensive stocks, weak rights, or a currency that absorbs the benefit. The mandate should be evaluated as an exposure and operating contract, not as a growth adjective. For an unhedged investor, local return and currency return combine multiplicatively. The home currency return equals 1 plus the local return multiplied by 1 plus the currency return minus 1. The currency return is measured from the home investor's perspective. If the foreign currency weakens against the dollar, that currency contribution is negative for a U.S. investor. Use the example on the slide. The stock rises 10% in local currency, so the local growth factor is 1.10. The foreign currency falls 12% against the dollar, so the currency factor is 0.88. Multiply them and subtract 1. The result is negative 3.2% before fees, withholding tax, custody, and trading cost. Simple addition would suggest negative 2%, which is close here but not exact. When the moves become larger, the interaction matters more. Hedging changes the formula by replacing some currency movement with hedge results, forward points, transaction costs, collateral, and roll effects. It does not make the currency layer disappear from the operating process. This is one of the most useful calculations in the chapter because it explains how the manager can be right about the company and wrong about the investor result. The stock did not betray the thesis. The exchange rate simply refused to be a supporting character. Currency hedging is a policy choice, not a free button labeled reduce risk. An unhedged portfolio keeps the currency exposure, which can diversify the local asset return or dominate it. A fully hedged policy attempts to remove most currency movement, but it pays or receives forward points, incurs trading and roll cost, uses counterparty capacity, and may require collateral. A partial hedge balances risk reduction with diversification and cost, but the ratio must be defined and governed. A dynamic hedge changes the ratio based on valuation, volatility, trend, or liability signals. That may add value, but it also introduces model risk and the temptation to turn a strategic policy into a series of macro forecasts. Currency hedged share classes create another layer. They generally hedge the class exposure, not the entire economic risk of the underlying companies. And they do not guarantee that hedge classes will produce identical returns. A natural hedge may exist when the investor has liabilities, revenues, or spending in the same foreign currency. The policy should state its objective, benchmark treatment instruments, rebalancing frequency, tolerance bands, shouts out collateral rules, and exception process. In 2022, a strong dollar made unhedged foreign holdings painful for many U.S. investors, even when some local markets held up better. That episode does not prove full hedging is always correct. It proves the policy should exist before the currency starts giving the portfolio manager feedback. Cross-border operations can become the weakest link in an otherwise sound investment. Settlement cycles vary by market, and some markets require pre-funding, local matching, special account structures, or different treatment of failed trades. Holidays do not line up neatly across countries, which is an elegant way for a simple settlement instruction to become a 3-time zone conference call. Assets may be held through central depositories, nominees, and local subcustodians. That chain must preserve ownership evidence, asset segregation, cash control, and timely reporting. Corporate actions add language, documentation, ARCI, market practice, and deadline risk. A rights offering or tender is not helpful if the instruction arrives after the local cutoff. Withholding tax affects the income investors actually receive, and treaty reclaims may take substantial documentation and time. Foreign ownership limits can constrain a position or prevent conversion between local shares and depository receipts. Sanctions and capital controls can freeze assets, block settlement, restrict trading, or make repatriation impossible. Like the 2022 sanction shock was a vivid reminder that a security can move from liquid portfolio holding to valuation and custody problem almost overnight. Operational due diligence should therefore be completed before the first trade. The portfolio manager should know where the asset will be held, how it will settle, who monitors legal changes, and how the fund exits if the normal market mechanism stops working. This chart measures the scale and regional concentration of regulated open-end funds at year-end 2025. The reported worldwide total is about $88 trillion across 44 jurisdictions and roughly 148,700 regulated funds. The United States accounts for about $44.8 trillion, Europe about $27.9 trillion, Asia Pacific about $10.2 trillion, and the rest of the world about $5.1 trillion. The first observation is concentration. A global industry does not mean an evenly distributed industry. The second observation is that domicile and investor exposure are different concepts. A fund domiciled in one jurisdiction may invest globally and be sold in several others. The third observation is definitional. These totals include regulated open-end vehicles such as mutual funds, ETFs, and institutional funds, and regional reporting conventions may differ. The chart is useful for understanding the infrastructure and commercial importance of major fund markets. It is not a forecast of which region will outperform or where the best fund is located. Asset totals often describe where capital has accumulated, not where future returns are cheapest. A large market can offer scale, liquidity, and strong institutions. It can also offer very efficient prices and a great deal of competition. Size tells us the industry matters. It does not save us from doing the next page of analysis. The history of global investing alternates between greater access and reminders that access can reverse. In the 1980s, foreign investor access and international fund offerings expanded. The 1997 Asian financial crisis then showed how currency pegs, short-term foreign borrowing, banking weakness, and capital flight could reinforce one another across borders. In 2001, China's entry into the World Trade Organization accelerated trade integration and eventually changed global benchmarks and portfolio construction. In 2008, the financial crisis demonstrated that liquidity and funding stress could raise correlations across countries that appeared economically different. In 2020, the pandemic tested market closures, policy coordination, valuation, hedging, and remote operations across time zones. From 2022 through 2026, war sanctions, trade policy, industrial policy, and supply chain security became direct portfolio constraints rather than background geopolitical commentary. The durable lesson is not that cross-border investing is too risky. It is that the source of risk changes. One period may be dominated by currency mismatch, another by banks, dollar funding, market closure, sanctions, or national security policy. The manager needs a process capable of updating country and operating assumptions without abandoning the investment discipline every time the news cycle accelerates. Markets open gradually and sometimes close in a hurry. The exit plan deserves a seat at the research meeting. Now apply the home currency return framework. A U.S. fund buys a European industrial company after identifying improving margins and an attractive valuation. The stock rises 15% in euros. The company thesis worked. During the same period, however, the euro falls 18% against the dollar. The home currency result is 1.15 multiplied by 0.82 minus 1. That equals approximately negative 5.7% before fees, tax, and trading costs. The local security selection added value, but the currency contribution was larger and negative. The correct response is not to declare that unhedged investing is always wrong. Start with attribution. Separate the local stock, the local market, the currency, taxes, and implementation. Then examine policy. Was the unhedged position part of a documented long-term approach, or did the manager simply fail to make a decision? Next, examine the portfolio. Were currency exposures diversified across several countries, or was the fund unintentionally concentrated in one macro view? Finally, communicate the result honestly. The issuer thesis can be correct while the shareholder's measured return is negative. A sound process can have a bad one-year outcome, but the process should make the source of that outcome visible. The company did its job. The exchange rate sent a different invoice. Attribution is how we determine who signed it. This matrix separates expected return or valuation opportunity from investability and institutional quality. It is a research template, not a permanent ranking of countries. A developed core market may have strong institutions and deep liquidity. but offer less obvious valuation opportunity. A smaller developed market can provide differentiated companies with good ownership rights but limited trading capacity. A large emerging market may offer growth and scale while introducing state influence, currency volatility, or foreign ownership constraints. A commodity exporter may look attractive when the cycle turns, but the return can depend heavily on one commodity, fiscal policy, and the exchange rate. A frontier reform story may offer extraordinary upside if institutions improve, yet the investment can remain difficult to own, value, or exit. A capital control market may show compelling local valuation while preventing reliable conversion or repatriation. The point is to make the trade-off explicit. Opportunity includes growth, valuation, reform, factor exposure, and diversification. Investability includes law, governance, accounting, custody, settlement, tax, sanctions, liquidity, and property rights. A security can be cheap because the market is wrong. It can also be cheap because the investor is buying a legal and operational obstacle course. The manager's job is to determine which risks are compensated and which make the expected return unavailable in practice. Return on a spreadsheet is not the same as return that can be wired home. A disciplined cross-border memo integrates the security thesis with the ownership and operating stack. First, state the thesis. Include issuer or sovereign fundamentals, valuation, catalyst, expected return, downside, and benchmark role. Second, map the currency. Identify the exposure, macro drivers, valuation, hedge policy, cost, instruments, collateral, and stress scenarios. Third, analyze the country. Cover politics, law, taxes, governance, sanctions, capital controls, property rights, and the risk that index classification or market status changes. Fourth, document access. Specify the instrument, foreign ownership limit, account structure, broker, venue, ownership evidence, shorting rules, and exit capacity. Fifth, map operations. Identify the custody chain, settlement cycle, holidays, foreign exchange process, tax reclaim requirements, corporate actions, pricing sources, and data controls. Sixth, define monitoring. Set triggers for re-underwriting, changing the hedge, reducing the position, suspending purchases, applying a valuation adjustment, or exiting. The memo should distinguish a market loss from an operational failure and a thesis change from a legal constraint. It should also identify who owns each decision when the time zones do not cooperate. Cross-border alpha is not realized when the price rises on a local screen. It is realized when the fund can own the asset, value it, service it, sell it, and return the proceeds to shareholders. Until then, the alpha is still clearing customs. Pause the presentation and make a recommendation before hearing the analysis. The fund wants a 1.5% position in an emerging market bank. The local share is cheaper and more liquid, but it requires a new market account, local currency funding, and access to a foreign ownership limit that is nearly full. The US traded ADR is easier to settle, but it trades at a premium, has lower volume, and could be terminated by the depositary. Withholding tax documentation is incomplete. The holiday calendar differs, and sanctions could change the exit path. Start with economic equivalence. Confirm the depositary ratio, fees, dividend treatment, voting rights, conversion process, corporate action treatment, and whether the ADR represents the same class of underlying share. Next, compare liquidity under stress, not only average volume. The local line may be deeper today, but ownership headroom and convertibility can make the exit less reliable. Then test operational readiness. the local trade should not occur until the account, custody, foreign exchange, tax, settlement, and sanctions controls are complete. My provisional recommendation would be to defer the full position. If the investment thesis is time sensitive and the ADR has adequate executable liquidity, a smaller initial ADR position could serve as a temporary access route with explicit premium, termination, sanctions, and conversion limits. The fund should not force the local line simply because it is cheaper. The cheapest line item can become the most expensive ownership problem. In cross-border markets, convenience has a price. And so does discovering too late that you bought the wrong kind of convenience. Pause the presentation and answer all 4 questions before checking the explanations. Question 1. How do local and currency returns combine for an unhedged investor? Are they always added, multiplied using 1 plus local return times 1 plus currency return minus 1, unaffected by currency, or averaged? Question 2. What is home bias? Is it a custody fee, holding more domestic assets than a neutral global opportunity set would imply, a currency hedge, or a tax treaty? Question 3. Why can an ADR and a local share differ? Are they always identical? Can fees, liquidity, conversion ratios, rights, depository arrangements, and market access differ? Does an ADR eliminate issuer exposure? Or can local shares not pay dividends? Question 4. What is an investability screen? Is it only a performance ranking, an assessment of access, ownership, liquidity, custody, settlement, tax, law, sanctions, and exit, a marketing document, or a share class? Pause now and write 1 sentence explaining each answer. The correct answers are: local and currency returns compound multiplicatively. Home bias is an overweight to domestic assets relative to a neutral global opportunity set. ADRs and local shares can differ materially in economics and ownership mechanics. And an investability screen tests whether the fund can legally and operationally own, value, service, trade, and exit the exposure. The explanation matters more than the letter. Multiple choice can reward a lucky click. Custody rarely does. Carry 6 claims forward. First, global investing broadens the opportunity set. It adds companies, issuers, economic cycles, factors, currencies, and potential diversification. Second, return has a currency layer. Local and foreign exchange returns compound. And hedging changes risk while adding cost, collateral, role, and governance. Third, country risk is investment risk. Law, politics, taxes, sanctions, capital controls, governance, and property rights affect the value shareholders can realize. Fourth, access is not the same as ownership quality. ADRs, local shares, swaps, mutual funds, and ETFs can provide similar economic exposure with different fees, rights, liquidity, counterparties, and exit risks. Fifth, operations set the boundary of the investable universe. Custody, settlement, tax, data, ownership limits, corporate actions, and foreign exchange processes determine whether the position can function. Sixth, diversification can weaken in a crisis. Common dollar funding, liquidity, policy, and risk aversion shocks can raise correlations across countries. The larger lesson is that global investing does not add one new variable. It adds an interconnected operating stack. The manager's work is not complete when the foreign stock rises. The result must survive currency translation, tax, custody, and exit. Cross-border alpha is not home until the cash is home. In Chapter 18, we reverse the direction of travel and examine how fund sponsors design products and gather assets across borders. This final page is the refresh register for Chapter 17. Posen and Hamaker provide the conceptual and operating architecture. The Investment Company Institute and the International Investment Funds Association provide the worldwide regulated fund statistics and regional context. The SEC's investor.gov material explains the investor-facing risks of international investing. MSCI and FTSE Russell provide country classification and index methodology resources that help define developed, emerging, and frontier opportunity sets. The Bank for International Settlements provides foreign exchange and cross-border market data. IOSCO materials help frame custody, market access, and cross-border securities principles. Do not read the long web addresses allowed in the video. Use them as the evidence trail behind the chapter. Each source answers a different question. Official statistics can describe scale. Index methodology can define the benchmark universe. Regulatory and investor materials can identify legal or operational risks. None of those sources proves that a particular security is attractive, that an ADR is equivalent to the local share, that a tax reclaim will arrive on time, or that capital can be repatriated during stress. Those conclusions require current fund documents, local legal advice, service provider evidence, market data, and a documented investment process. Chapter 18 takes the same cross-border complexity and looks at it from the fund sponsor's perspective. Managing a global strategy is difficult. Selling and servicing it across jurisdictions adds an entirely new collection of forms, permissions, platforms, and people. Finance rarely removes complexity. It usually changes which department owns it